Welcome to Asset TV's View from the Floor. I'm Ritika Gupta, and joining me is Tim Anderson, the Managing Director of TJM Investments. Tim, it is a pleasure to have you on.
It's so nice to talk to you this morning.
So first of all, we're just 1 week out from that all-important Fed decision. And in the run-up to that, the backdrop is an economy in the US that is slowing down. If you look at the employment figures, if you look at inflation data, and while maybe the expectation is that the Fed holds on pat, investors are going to be looking for some clues on the outlook. So what is your overall take going into that Fed decision?
Well, I have a very contrary opinion that I still think 2 to 3 cuts are very much in play this year. And I think if the Fed really is paying attention to the data of the last few weeks, we've had some very weak data on the economy. If they want to avoid the criticism that they've had for decades of always being late to move in both directions, I think they could justify cutting next week, but I doubt that they will. I would hope that through their language and through his Q&A, which is usually the main market moving event, that he starts setting the stage for the likelihood of a cut in July. We had a Chicago Purchasing Managers report last week that came in at 35, an extremely low number given the expansion contraction threshold of 50. So clearly the economy in that part of the country is in contraction. That was the lowest number since the depths of COVID. And I just think that I know they're hyper-focused on the inflation number, but there's so many other indicators out there. They want to, and given the fact that any move in rates, up or down, and the next move is going to be a cut, takes a few months to even trickle into the economy, I could easily see 2 to 3 cuts warranted this year.
And on that point, you mentioned swap contracts. They're predicting 2 to 3 rate cuts by year end. But inflation, it's coming down, but it's still not at that 2% target. It's still a little off from there. So what more is needed for the Fed to initiate an easing cycle?
They need to feel that they can envision inflation getting to 2%, that it's on the way to 2%. Now, a few months ago, it looked like that, and then it stalled out at around 3.2. Now I think it's probably just below 3. I think if you really looked at the details, you're probably talking 2.8 to 3.0. And I think that the big sticking point right now has been housing. And housing is clearly lags. It's not nearly as transactional as a lot of other components of the inflation reports that they look at. But I would certainly think that with the jobs market starting to show some gradual weakness and the production part of the economy starting to show a lot of PMI numbers below 50, with the extreme being the Chicago Purchasing Managers report, that the economy is going to slow, it's going to have an impact on jobs, and down the road, I think the Fed will wish that they had been more proactive.
And of course, we have more economic data to chew on. We've had the ISM, the ADP, and then on Friday, all eyes on that jobs report, the estimate about consensus 180 to 190,000 jobs added. Do you think that is really going to be enough to move the dial for the Fed, whatever this jobs print may be?
I think you have to pay very close attention to the revisions, because the revisions clearly, look, it's June 6th, okay? We're going to get a May employment report. May just ended last week. So these reports always come from surveys. A lot of people get frustrated with the revisions of the jobs report, but you want timely reports. They come from surveys the 3rd week of the month. And then as the raw data rolls in, you get revisions that more accurately reflect reality. So it's very important to watch the revisions for both April and March, because the revisions, our view is they always give you a very good indication of which way the employment market is trending. So if we get downward revisions, that means we're seeing more slowing in the jobs market than we have thought that there is. And if we get upward revisions, that means that the market is still tight.
And in terms of stock market reaction, we're still trading around record highs despite maybe some of the data deteriorating somewhat. So is bad news for the economy good news for stocks, or when might we start to see that narrative change?
Rather than getting into a bad news, good news conversation, I just think that what we want to see the inflation numbers continue to trend a little bit lower, even if it's just gradually. I mean, we're down from 9% to 3%. So that's a big move down after a big move up. And clearly getting to that, getting down below 2.5 is going to take a little bit more progress. But I do think that we're likely heading in that direction.
We're seeing poor market breadth, though, lower participation in the rally. I mean, it's really driven by those magnificent 7 names. Will we see wider participation in the rally? Can this bull run really continue?
You know, the Russell has acted very well. The Russell 2000, obviously a small cap index, has acted very well over the last week and a half. Probably outperformed the Dow, maybe even the S&P. And a couple of days last week when the market was particularly weak, when there was some bad news on a couple of big blue chip stocks, Dell Computer, Salesforce, had the Dow down close to 1%. The Russell was actually positive on those days, and we had positive breadth. Not yesterday, but even toward the end of last week when the market was selling off. So I know that year to date, the broad market has underperformed, but we've seen some very positive indications just in the last week and a half that's starting to turn a little bit. Now keep in mind, the annual Russell reconstitution takes place in the 3rd week of June. So there's a lot of pre-positioning going on to that, toward that. And we also keep in mind that we've got 1 month left in the first half of the year. A very key marker for money managers' performance numbers, and make no mistake about it, they run so much money today that they're already well into thinking about how they want to be positioned for the second half of the year. That's why watching relative strength of sectors in June is very important, because it will tell you where the big money wants to be positioned for the second half of the year.
And speaking of sectors, big tech, again, year to date, your star performer. I mean, but at the same time, it's driven by AI. Will that momentum start to fade? We've still got very high valuations. Does the tech rally have room to run?
Well, I certainly think that it does. I think that the AI revolution is in very, very, very early innings. And it's got a long way to go. Now, the noise and the uncertainty comes from sorting out who the real beneficiaries are going to be and which companies maybe have had big moves to the upside just with a rising tide lifting all boats, so to speak. So there's no doubt that this is going to be a real impact on the tech sector and on the tech-driven part of the economy. It's just what companies, other than, of course, NVIDIA, are going to be the largest beneficiaries.
And Tim, before I let you go, with earnings in the rearview mirror, I mean, what's the focus now for stocks? Is it the potential of lower rates, or is it the deteriorating economic data? What's your take on that?
Well, I think that the economic data is always going to be important, because that is going to drive where the Fed is, not just for next week's meeting, but for July's meeting and then the meetings in the second half of the year. But also watch the relative sector strength in June. I just have to go back to that, because that will give you a very good idea of where the big money asset managers are looking to overweight and maybe underweight their portfolios for the second half of the year.
Thank you, Tim, so much for joining us. That was Tim Anderson there, the Managing Director of TJM Investments.